Hey guys, this is Vyom Joshi with Superior North. Welcome back to my channel. This week we will be talking about ExxonMobil. As we all know, oil and gas sector has been in a slump right now, and this is the prime time for us value investors to see if we can find any undervalued securities in that sector. We will be reviewing ExxonMobil's 10K annual report. We'll look at the business segments, the business model, review the risk factors, as well as the contingent liabilities associated with investing in this company. So let's dive in and look at ExxonMobil.
Hey guys, let's start off by looking at the Form 10K that ExxonMobil filed with the SEC. This is for the fiscal year that ended December 31st, 2019. So if you're watching this with me in 2020, this is the most recent 10K annual report that we have on hand. Let's begin by reviewing item 1, where ExxonMobil describes the core business of the company. Over here, ExxonMobil says that their principal business involves exploration for and production of crude oil and natural gas, and manufacture, trade, transport, and sale of crude oil, natural gas, petroleum products, petrochemicals, and a wide variety of specialty products. As far as the operating information and business segments go, Exxon asked us to review these sections within the annual report. So let's go through these notes so that we can better understand Exxon's strategies, business models, and operating segments. Note 18 is about disclosures about segments and related information. It states that the upstream, downstream, and chemical functions best define the operating segments of the business that are reported separately. It states that the upstream segment is organized and operates to explore for and produce crude oil and natural gas. The downstream segment is organized and operates to manufacture and sell petroleum products. And lastly, the chemical segment is organized and operates to manufacture and sell petrochemicals. So to sum it up, ExxonMobil operates in 3 segments. Upstream segment, which involves extraction and exploration of crude oil. The second is the downstream segment, which involves the refining of the crude oil and the marketing and logistics involved with getting that end product to the user. And the third segment is the chemical segment, which involves the manufacture and sale of petrochemical products. Now let's look at the long-term business outlook that the management forecasts for the industry as well as ExxonMobil. The management states that as economies and population grow, and as living standards improve for billions of people, the need for energy is expected to continue to rise. Even with significant efficiency gains, global energy demand is projected to rise by about 20% from 2017 to 2040. After that, the management discusses how light-duty vehicle demand for liquid fuels is projected to peak prior to 2025 and then decline to levels seen in the early 2010s by 2040. As the impact of better fuel economy and significant growth in electric vehicles led by China, Europe, and the United States work to offset growth in the worldwide car fleet of about 70%. After that, management talks about how the global natural gas demand is expected to rise about 35% from 2017 to 2040, with about half of that increase coming from the Asia-Pacific region. On the next page, the management forecasts how the energy breakdown will be by 2040. It states that the world's energy mix is highly diverse and will remain so through 2040. Oil is expected to remain the largest source of energy, with its share remaining close to 30% in 2040. In the rest of the paragraph, management discusses the changes in demand, and it can be summed up in this one line here. By 2040, the sources of energy would comprise of oil, which would be about 30%, natural gas, 25%, coal, 20%, renewable energy, 15%, and nuclear will be about 10%. After that, the management discusses its strategies related with its upstream segment. It states that ExxonMobil continues to sustain a diverse growth portfolio of exploration and development opportunities, and that these strategies are underpinned by relentless focus on operational excellence, development of our employees, and investment in the communities within which we operate. Exxon states that based on current investment plans, oil equivalent production from the Americas is expected to increase to be a majority of total production over the next several years. Further, the proportion of our global production from unconventional, deepwater, and LNG resource types currently contribute nearly half of our global production and is expected to grow to about 60% in the next few years. After that, Exxon describes how crude oil and natural gas prices are determined by the supply and demand of the product, and that demand is primarily driven by economic activities, level of prosperity, technology advancements, consumer preference, and government policies. On the other hand, on the supply side, prices are primarily impacted by political events and the actions of OPEC and other large government resource owners. At the end of the upstream segment section, Exxon states that in the more mature conventional operations, Our primary goal is to maximize cash flow generation through ExxonMobil's world-class workforce and best practices in reliability and project execution. Next is the downstream segment. Exxon describes the downstream segment as a large, diversified business with global logistics, trading, refining, and marketing. Exxon's operating results show that it has 21 refineries located in 14 countries with distillation capacity of 4.7 million barrels per day and lubricant base stock manufacturing capacity of 129,000 barrels per day. Within the downstream segment, Exxon talks about how Alberta imposed limits on crude production, which lowered their refinery margins in Canada and Midwest regions. In the near term, it expects to continue to see variability in refining margin following the dynamics of supply and demand balance. After that, Exxon gives us a higher level idea of how to determine the profitability of a refinery. It states that refining margins are largely driven by differences in the commodity prices and a function of the difference between what a refinery pays for its raw materials, primarily crude oil, and the market price for the range of products produced, primarily gasoline, heating oil, diesel oil, jet fuel, and fuel oil. So when we hear about crude oil prices turning negative or being very low, it's actually a very profitable time for the refineries as long as there is demand on the other end for its products. So it can buy its raw material, crude oil, for cheap and then sell the end product to its customers and get a pretty fat margin of profit in the way. After that, Exxon describes the factors that influence the prices of these commodities, such as global and regional supply-demand balances, inventory levels, industrial refinery operations, import-export balances, currency fluctuations, seasonal demand, weather, and political climate. After that, Exxon states that its long-term outlook for its industrial refining margins will remain volatile. However, its integration, including logistics, trading, refining, and marketing, will give it a competitive advantage in the marketplace. After that, management states that when investing in downstream segment, ExxonMobil remains focused on selective and resilient projects. Management then talks about the three key projects that started at the end of 2018, which ended up creating incremental earnings in 2019. And finally, the management goes over the last segment, which is the chemicals. The report states that ExxonMobil is a major manufacturer and marketer of petrochemicals and a wide variety of specialty products. For this segment, ExxonMobil states that it has its competitive advantage through continued operational excellence, investment and cost discipline, a balanced portfolio of products, and integration with downstream and upstream operations, all underpinned by proprietary technology. ExxonMobil estimates that global demand for chemicals will rise by approximately 45% by 2030, driven by continued global growth of the middle class. After that, the 10K goes into detail about some of the expansion projects that ExxonMobil is involved in, such as the polyethylene plant in Beaumont, Texas, the Baytown polyethylene lines, which started in 2017, and it helps to meet the rapidly growing global demand for performance polymers. It talks about the performance polypropylene upgrade in Baton Rouge, the Baytown chemical expansion project, which broke ground in 2019. It states that construction also began in San Patricio County, Texas, on our joint venture ethane cracker and associated derivative units. And lastly, it continues to progress plans for world-scale steam cracker and performance derivative units in China. Hey guys, now let's review the risk factors. ExxonMobil had 24 total risk factors listed in its 10K, and today we will be going over the top 5. The first risk factor that I'll be going over is the economic condition. Over here, Exxon states that the demand for energy and petrochemicals is generally linked closely with broad-based economic activities and levels of prosperity. It outlines how low or negative economic growth will typically have an adverse effect on its operating results. Exxon then gives examples of various factors that can impact the demand for energy and petrochemicals, general economic conditions such as changes in population growth rates, periods of civil unrest, government austerity programs, trade tariffs, security or public health concerns, or currency exchange rate fluctuations. So in this risk factor about economic conditions, Exxon goes over the situations in which its business as well as its income can be adversely affected. The second risk factor is about regulatory and litigation risks. Over here, Exxon discusses how it remains exposed to changes in law or interpretation of settled laws that could adversely affect its results. Some of the examples include increases in taxes, duties, or government royalty rates, price control, environmental regulations, mandating efficiency standards, requiring Exxon to violate the non-disclosure laws of other countries, And finally, government actions could be detrimental for the company. At the end, Exxon states that we may be adversely affected by outcomes of litigation, especially in countries such as the United States, in which very large and unpredictable punitive damage awards may occur. So, in this risk factor about regulatory and litigation risks, Exxon talks about how it can be monetarily affected by changes in laws or interpretation of settled laws. The third risk factor is about climate change and greenhouse gas restrictions. Exxon states that due to concern over the risks of climate change, a number of countries have adopted or are considering the adoption of regulatory framework to reduce greenhouse gas emissions. It outlines that such policies could make our products more expensive, less competitive, lengthen project implementation times, and reduce demand for hydrocarbons, as well as shift hydrocarbon demand towards relatively lower carbon sources such as natural gas. And lastly, it states that such regulations or policies also increases its compliance costs, such as monitoring and sequestering emissions. And while we're talking about climate change and greenhouse gas emissions, I wanted to quickly go over some of Exxon's alternative energy research projects. These focus on developing algae-based biofuels, carbon capture and storage, breakthrough energy efficiency processes, advanced energy-saving materials, and other technologies. So in this risk factor, we can see that as countries start to learn more about climate change, they're going to have new policies and regulations in place. And as Exxon starts complying with those regulations, things are going to be a lot more expensive for Exxon, which will hinder and reduce Exxon's profit margin. The fourth risk factor we'll go over is about project and portfolio management. Over here, Exxon states that its long-term success in all its operating segments depend on complex, long-term, capital-intensive projects. And these projects in turn require a high degree of project management expertise to maximize efficiency. Exxon states that there are specific factors that can affect the performance of major projects, which include the ability to negotiate successfully, develop markets for project outputs, manage changes in operating conditions, prevent and respond effectively to unforeseen circumstances, influence the performance of project operators, and lastly, ExxonMobil's success, including its ability to mitigate risk and provide attractive returns to shareholders, depends on its ability to successfully manage its overall portfolio. After that, Exxon briefly talks about the risks associated with divesting its assets. So this risk factor can be summed up by saying that project execution is the key, not only in the early stage, but even when Exxon goes to divest its assets, it has some risks associated with the timeline and the price it may get when it tries to sell its assets. The fifth and last risk factor we'll be going over is competition. Exxon states that the energy and petrochemical industry is highly competitive. It not only faces competition from private firms, but also from state-owned companies. Exxon claims that in some cases, these state-owned companies may pursue opportunities in furtherance of strategic objectives of their government owners, with less focus on financial returns than companies owned by private shareholders such as ExxonMobil. And lastly, technology and expertise provided by industry service companies may reduce the need for resource-owning countries to partner with private sector oil and gas companies in order to monetize national resources. So this risk factor can be summed up by saying that Exxon has cutthroat competition. It not only faces competition from the private firms, but also from state-owned companies. And as these state-owned companies start getting the technology and expertise needed to extract the crude oil and refine it, it would no longer need to partner up with these private sector oil and gas companies such as ExxonMobil. Hey guys, now let's review note 16 of the annual report, which goes over the litigation and other contingencies of ExxonMobil. Exxon states that a variety of claims have been made against ExxonMobil and certain of its consolidated subsidiaries in a number of pending lawsuits. ExxonMobil did not disclose any of these pending lawsuits, which were against its favor. Exxon states that the corporation does not record liabilities when the likelihood that the liability has been incurred is probable, but the amount cannot be reasonably estimated, or when the liability is believed to be only reasonably possible or remote. And so what this means is when you look at the balance sheet, ExxonMobil is not going to have a number for the litigation and contingencies section. It'll tell you to go to this note that we're looking at right now. And in this note, it would usually go over the court cases that, hey, these are the cases that are against us. In the case of ExxonMobil, they do not disclose any of the cases that are against them. They're only reporting two cases, which if it goes in their favor, they'll be making a lot of money. And if it doesn't go in their favor, then they have nothing to lose. So this could just mean that ExxonMobil is not involved in any court cases, which could significantly affect ExxonMobil's financials. After that, Exxon talks about other contingencies, where the company goes over its contingent liabilities associated with guarantees relating to notes, loans, and performance under contracts. ExxonMobil's share for these guarantees would be about $1.7 billion. The report then goes into detail about two court cases which would benefit ExxonMobil financially if it went in its favor. The first court case was with the Venezuelan government about how it took control over Exxon's assets, and it has an award of about $1.4 billion. But the court case is still going on, and we do not know when this award and if this $1.4 billion award would ever get awarded to ExxonMobil. The second court case is about how an affiliate of ExxonMobil turned in the Nigerian National Petroleum Corporation because it lifted crude oil in excess of its entitlement under the terms of the production sharing contract. So in this court case, awarding damages to the ExxonMobil affiliates would amount to approximately $1.8 billion plus $230 million of accrued interest. And as we know, the court case is still going on. And at the end, ExxonMobil states that regardless of the outcome of the enforcement proceedings, the corporation does not expect the proceedings to have a material effect upon the corporation's operations or financial condition. Next, looking at the commitments. So these are the numbers and the obligations that ExxonMobil has. Regardless if it's making money or not, that doesn't matter. ExxonMobil still has to meet these commitments. And as we can see, if we add up all these commitments up, which includes leases, repayments, pension obligations, we get that in 2020, Exxon would have a commitment of $21.7 billion. So if we add the numbers up for all the years from 2020 all the way to 2025 and beyond, we get that ExxonMobil has a total obligation of about $123.5 billion. ExxonMobil states that inclusion of such commitments would not be meaningful in assessing liquidity and cash flow because these purchases will be offset in the same period by cash received from the related sales transactions. So as investors, we cannot just rely on the statement where Exxon claims that such commitments will be offset by the sales volumes because the sales volumes have dropped off. And regardless if Exxon makes money or not, it still owes and it has a commitment of $21.7 billion for the year 2020. And lastly, I wanted to go over Note 17, which talks about pension and other post-retirement benefits, primarily because ExxonMobil is one of the companies who still has pension plans for its current and new employees. Over here, we can see all the costs associated with the pension plan. The number that we specifically need to look at is the benefit obligation at December 31st. We'll focus on the US 2019 number. However, all the numbers for US, non-US, and other post-retirement benefits would stay the same. We're going to get the same trend when we look at how much fund is available to fulfill these obligations. Focusing on the US 2019 number, we see that the obligation that ExxonMobil has is $20,959 million. And if we go down to the fair value, which is how much the fund actually has, we can see that there's only $13,636 million available. So we can see that there is a shortfall. Its obligations are $20,959 million. However, it only has $13,636 million available. And the way that it would fulfill this obligation would be taking on more debt or finding a way to finance the shortfall. One of the interesting things that I found in this annual report is that ExxonMobil states that a 1 percentage point increase in the healthcare cost trend rate would increase service and interest costs by $85 million and the post-retirement benefit obligation by $921 million. A percentage point decrease in the healthcare cost trend rate would decrease service and interest rate costs by $63 million and the post-retirement benefit obligation by $726 million. So ExxonMobil assumes that the healthcare cost trend would be 4.5% in 2021 and beyond. And if the trend were to increase more than 4.5%, then ExxonMobil would have a post-retirement benefit obligation that's much in excess to what it's expecting. To sum up this discussion about pensions, we can state that Exxon's projected benefit obligation is greater than the value of its pension investment, and that the company's pension fund investments are not enough to cover the future benefits that management expects to pay the employees. All right, guys, that is all I have for you this week. We looked at ExxonMobil's core business. We looked at the business segments, reviewed the risk factors, as well as the contingent liabilities and commitments associated with investing in this company. Hopefully you found this interesting. Please do like, share, comment, and subscribe to my channel. Thank you.